Lalit Khaitan, whole-time director and CFO at RK Forgings, is now joining us. Mr. Khaitan, thank you for taking your time out. Ashesha this side. And first of all, congratulations on the very strong set of numbers that you have reported. Revenue up a solid 20%, EBITDA growth of more than 50% on a sequential basis, and that justifies the kind of up move that we are seeing in the stock. What led to this kind of outperformance, and most importantly, how much of this growth is sustainable in the coming quarters?
No, certainly the kind of growth what we have performed, we were seeing it for quite some time, and it was being articulated by us. It's a matter of time we are going to get this kind of performance, and this is quite sustainable because we see quite a tailwind in export market as well as the sectors we have having expansions. So everywhere the new orders are getting executed, and this trend will continue, and very much I think we will improve from here.
What kind of growth, Mr. Khaitan, are you penciling in for the full year FY27 as compared to FY26?
We are giving a guidance of 20% growth year on year.
Okay, so 20% growth guidance for FY27 over FY26. That's the word coming in. And which segments are aiding this kind of growth? Is it commercial vehicles, passenger vehicles, railways, or even mining for that matter? Or is it demand that we are seeing across the board?
See, commercial vehicle are our base, and certainly growth will be there. But certainly the key sector where we are now working and getting good traction is railway. We are getting good orders from the oil and gas, and even working on the EV side of the passenger vehicle, and even a little bit of passenger vehicle. All will add to the growth, and certainly more will come from non-auto sector.
Okay, so most growth is likely to come in from non-auto sector. That's the word coming in. Mr. Khaitan, there have also been some order wins, one from Indian Railways, metro segment in the quarter gone by. Is this the first of many, and any other big order that is in the pipeline for you?
So see, in the last 2 years, we have won significant order, and this is a continuous process. And we keep on winning order, and whatever new orders we win, we keep on announcing quarterly to the exchanges. And I will say we have quite healthy order book right now, or in the last 2 years on the back of especially railways and oil and gas. So we are going to continue with this kind of wins, and we will keep you informing on that.
Understood. And one of the other factors which played a very crucial role was also exports. And you did talk about that in your first answer. I believe you are now expecting 20% plus growth rate even for the export sector in FY27. This will be supported by both Europe as well as North America. What gives you this kind of confidence, and has there been any negative impact of West Asia crisis at all that you have seen in the last few quarters?
See, certainly last year was not good for the exports due to this West Asia crisis and the tariff impact. Both mixed it, and we were not able to do the exports at the desired level. But certainly things have normalized. Even this West Asia crisis, a little bit hangover is there on the shipping cost, etc. But overall, I think it has become a new normal, and there is a quite significant demand coming up from all the quarters. And that's why that confidence we will do very good in exports in this year.
Okay, FY26 on exports front was weak, but that is expected to normalize in FY27. That's the word coming in. Mr. Khaitan, how much do exports contribute as a percentage of your total revenue pie? And how is this mix expected to change going forward?
So if you look at Q1 number, it was about 32% of my total pie. And if you look at 2024 or earlier, it was always more than 40%. So we are moving towards this 40%. Maybe this year we may move to 37, 38, and next year we may be more than 40% on the exports front.
Okay, so from 32% currently, it is expected to move to beyond 40%. And are margins for exports more accretive as compared to domestic margins?
Yeah, a little bit. So certainly exports gives us a little bit more margin.
That also means that margins will expand as the pie expands going forward. Am I getting it right?
Yeah. So a margin will expand, and margin are going to expand from year on, quarter on quarter.
Can you quantify how much could the margin expansion be in that case?
It's very difficult to quantify the margins, but certainly I can say maybe 50 basis point or 75 basis point, but it will improve quarter on quarter.
Understood. Let's also talk about your long-term vision. And I believe you are targeting about 8,000 crores of revenue by FY29 now versus FY28 earlier. What led to this one-year deferral? Is it West Asia or is it any other factor that is weighing heavy on your revenue growth?
No, certainly last year was not good. If you look at the performance for the FY26 was not good, and due to various reasons, including this tariff and West Asia. That's why the target for FY29 is now 8,000 crore.
Okay, and now that the production facility at Mexico has begun, how will the revenue ramp up be for the Mexico facility?
So yeah, Mexico is doing good, and the ramp up will start from this quarter, and we can see good revenue in next 2 to 3 quarters from Mexico.
Understood. And can you quantify how much revenue do you aim to generate from Mexico facility?
So this year, if you look at this financial year, we may end up somewhere around 75 to 100 crore. From next year, we certainly will look at more than 200 crore from Mexico.
Understood. And let's also talk about aerospace and advanced alloy. These are the other two segments that you're looking to enter into. By when do you expect revenue generation from these two segments?
See, aerospace and advanced alloy, all these things are work in progress. It will take some time to materialize, and it's, I think, 2 to 3 years away when we will see revenue from these areas.
Okay, so revenue generation from aerospace and advanced alloy is likely to happen over the next 2 to 3 years. But what is the capacity expansion or the capex guidance for these new segments that you're looking to enter into?
That's not huge. So what we will look at, we need to do some little addition in the machines. Machines are a little bit fungible, but that I think sometime away. When we will decide on that, we will let you know.
Okay, and let's also talk about your total guidance then. FY27 capex guidance remains at around 350 crore, I believe. What will this be used for and how will that be funded? Will it be fully via internal accruals?
Yes, so FY27 will be funded via internal accrual, and a little bit of casting capability and the machining capability will be added in out of this, plus maintenance capex.
Okay, one last question, Mr. Khaitan, before we let you go, and that has to be around net debt, because that has reduced by about 100 crores in the quarter gone by. It is now at about 1900 crores, and I believe you're targeting 1500 crores of net debt by the end of this year. Does that continue to remain on track despite the capex guidance that you have, that you just shared in the previous answer?
Yeah. So certainly the capex guidance, what we have, considering that we have given the guidance for the net debt. And in the last quarter also, we always guided that we will be able to reduce the net debt by almost 500 crore. And out of that, we've already reduced 100. And we are on track of that, certainly.
Okay, so 1500 crore net debt by the end of this year, and you continue to maintain that deleveraging roadmap. Mr. Khaitan, thank you so much for taking your time out and joining us here on ET Now and sharing your thoughts on what the outlook is for the rest of this year and even for the next few years. The stock, of course, is sitting with gains of nearly 6%. Thank you for joining us today.
Thank you.
With that, let's also take a look at what the market is doing at this point in time, with Nifty holding on with gains of 0.6%. We're still about 70 points away from that 24,000 mark, but a good 150-point rally is what we are seeing for Indian equity markets, in line with what the GIFT Nifty was suggesting this morning. But that's all the time we have on this edition of the show. Thanks so much for tuning in. More news and updates will continue on the other side. Stay tuned.